about to witness another misleading oil meltdown? Last week, the May futures contract plummeted below zero. Remember, it fell to negative 37 as its lows before rebounding back to positive territory? Today, the June contract plunged to $12. I mean, these things are a mess. Now, I've been telling you to stay the heck away from crude for months. Even before the virus hit, I was bearish. But I also think the action in the May and June futures contracts can be very misleading. Notice how the oil stocks have been going up? So I want to put it in perspective. And that's why tonight we're going off the charts with the help of Carly Garner. She's a brilliant technician who's the co-founder of DeCarly Trading and the author of Higher Probability Commodity Trading. Garner's our resident commodities expert. And you know why? Well, because she's different. She's contrary. She knew oil was going down. Now, get this. She's bullish on oil here. Why? Let's take a look. First, this is the daily chart showing the West Texas Intermediate crude futures for May delivery, okay? It's in red. And the West Texas crude futures for August delivery, and that's in blue. Even when the May contract went sub-zero last week, the August contract held up pretty well. It's still well over $20. This is the new pattern. While the May and June prices have collapsed, the back month contracts are in much better shape. The May contract expired last week, and Garner points out that the June contract, the one that plummeted nearly 25% today, is now experiencing a lot of volatility, as ETFs that own this stuff are desperately trying to rebalance the portfolios to try to sidestep insolvency, and they're rookies. They're, pre-Jimmy Chill, I just said a bunch of clowns. But the key here is simple. Right now, we don't have enough storage. Notice how Nordic American Tanker was up huge again today, had them on Friday. And the oil companies waited way too long to cut production. So the crude that's earmarked for May and June delivery is getting hammered. However, the market seems pretty confident that the storage crisis will be worked out by August. And as you go further out, the prices get higher. We're talking in the 30s as we get deeper into 2020 deliveries. And that's why Garner's adamant that last week's oil crash was blown way out of proportion. In truth, get this. This wasn't talked about at all. Do you know there were only 10,000 futures contracts that traded in all of negative territory? We heard it was hundreds of thousands. She did a lot of work. There's only 10,000. In perspective, in an active month, you might see 700,000 to over 1 million of these contracts change hands each session. So where does oil go from here? Listen, we know the current environment is horrible for the industry. With millions of people working from home and tons of oil-intensive industries on life support, think the airlines, the cruise lines, the fundamentals do stink. The lockdown was always going to be brutal for oil. It was absolutely due for a correction. But as Garner points out, the cure for low commodity prices is low commodity prices. When the price of oil gets crushed, the industry slashes production, which is finally what's happening right now. You take out enough supply, prices stabilize. Once the economy starts bouncing back, prices go higher. You know, I think we need to be careful about reopening the economy before we're ready. But let's be very, very clear. The coronavirus pandemic, it is temporary. Sooner or later, we're going to get the situation under control, and business will bounce back. It's just whether it's sooner or whether it's later. We won't be sheltering in place forever. Let's destroy the economy. We can't let that happen. And when the economy rebounds, oil rebounds with it. I know the industry took too long to adjust, but you know what? It is finally happening. Look at this. Yeah, this is where we got really bearish in oil. Look what's happened. This is the rig count, okay? The Baker Hughes, that's a company that keeps track of the rig count for years. In most recent numbers from Friday, 60 oil rigs were taken offline. That leaves only 378 rigs in operation, 60 in 1 week. Garner points out that the shale industry hasn't cut backs like this since the beginning of 2016, when oil traded down to the 20s. That turned out to be a multi-year low. And we just saw a big bankruptcy in Diamond Offshore. It's a shallow water driller, mostly focused on the Gulf. Meanwhile, Garner thinks last week's meltdown has cleared most of the weak-handed speculators from the oil market. You had a lot of inexperienced traders bottom fishing prematurely. See all those Chinese people were doing that? And that probably contributed to the collapse in the futures. So supply is coming down, and foolish speculators have been wiped out. That's perfect for a rally. Let me show you where it leaves us, okay? This is a look at the monthly West Texas Intermediate crude oil futures chart. Because these contracts expire every month, this chart is a compilation of different contracts. That makes it tricky for technicians to gauge what's going on in oil. But Garner's a pro, so let's rely on her. Remember, the May and June contracts are misleading, okay? So we've got May and June right up here. These are misleading, which is why she thinks you need to ignore the last tick down here. The July contract bottomed at $17.50 last week. August contract bottomed near $20. They both held the trend line, even when the front month futures went negative. What else? Thanks to last week's plunge, the relative strength index, that's a very important momentum indicator. Will you look at this? Finally went below 30. That's astonishing. It's the first time that's happened on a monthly basis since 2016. Remember, that's when we got the big bounce. And only the second time it's happened in all since the 90s. This market is just totally oversold. Remember, I'm a bear, but I see an oversold market, and I like it. While this downturn felt different because of last week's messy sub-zero action, Garner wants us to remember that oil's no stranger to 80% declines. When you ignore the handful of May contracts that traded below zero, oil's now fallen 80% from its highs earlier this year. We saw the same thing happen during the financial crisis and again from 2014 and 2016 when the world was flooded with new shale oil. In both of these cases, oil prices eventually rebounded substantially from the lows. So unless we magically embrace renewable energy overnight, which we're not, Garner thinks West Texas Intermediate crude will get back to $40 a barrel, probably sooner than most people expect. Shocking? All right, look. Take a gander at the daily chart of the August contract. And I know this is convoluted, but bear with me. She thinks that gives you the best read on oil right now. I totally agree with that. By the time the August contract expires in late July, Garner suspects that the production cuts from OPEC and the U.S. shale producers will have worked their way through the system and will have a build-out of more storage. That means, by the way, you should sell North American tanker as we get closer to this. And it's possible that the global economy will be picking up steam, causing a rebound in demand. That wouldn't shock me. If that's the case, Garner expects the August WTI contract will stay above its floor of support of $20 a barrel. As long as that floor holds, okay, as long as this holds, or we only go a little bit beneath it, she's betting oil will return to the mid to high 30s with ceilings of resistance at 36, at 39, and 42. If the August contract gets to 42, we'll have filled in the gap left on March 9th. That was when the Saudis and the Russians started the ridiculous price war. Even if oil doesn't make a full recovery, Garner thinks a rebound to the mid to high 30s makes sense. 2 months ago, that would have seemed like a pretty low level. On the other hand, if the $20 floor of support breaks down, she thinks the August contract falling to $15, though, could happen. But she doubts that's going to really... And she doubts the bear's case. Here's the bottom line. Oh, by the way, if you believe this, this is a reason to buy Pioneer, PXD, to buy Parsley. That's a little dollar, a couple, small dollar amount stock. Parsley. It's a reason to buy EOG. It's a reason to buy Chevron, and it's a reason to buy the other FANG, the wrong FANG, Diamondback Energy. Bottom line. The charts, as interpreted by Carly Garner, suggest that oil could rebound substantially over the summer. And while that may sound like wild-eyed optimism right here, I think she makes a good point. I still recommend avoiding many of the stocks. I just gave you the only ones I buy. Situation's still murky. I wouldn't be surprised, though, if Garner's right. And if that's the case, it's Parsley, it's Pioneer, it's EOG, it's FANG, and it's Chevron. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.